Hello everyone, here is the quiz review video for flexible budgets and the flexible budget performance report. It is chapter 23 in Pearson. In order to do a flex budget performance report, you are going to need two things of great importance. The level of production and therefore the associated revenues and costs that you budgeted for at the beginning of the period, and what your actual results were. Well, where do we get this information from? The amount that we budgeted for comes from our master budget, and probably before that master budget was even prepared, someone in the company prepared what is called a flexible budget, and it is your estimated operating income at different levels of production. So here ABC Company made a flex budget for what their operating income would be if they made 9,000, 10,500, and 12,500 units respectively. Well, they went through after they made this budget, they did their normal course of operations, and they recorded their actual results. So every sale that they made, every time they had to pay for materials or labor, their variable costs, etc. Well, where did those actual results end up at? They ended up in our income statement, because that's where companies report the actual revenues and costs they had during the period. So if you have your budgeted amounts, which is going to come from your flex budget or your master budget, and you have your actual results, which are going to come from your income statement, you can prepare a flex budget performance report. And the first thing that we need for a flex budget performance report is to figure out what our budgeted level of production was and what our actual level of production was. Well, ABC Company is predicting at the beginning of the period they would sell 10,500 units, which means we can fill that in under the static budget section. They had actual sales and therefore actual production of 12,500 units. Well, we can fill that in under the actual results section. And the next step we need is to fill in the flexible budget column. And what the flexible budget is, it's what things should have cost given your actual level of production. So when you start your flex budget column, the first thing you need to do is carry over the actual amount of units that you produced during the period. So we're going to start off the flex budget column with 12,500 units. From there, we can begin to fill in the columns that we already have numbers for. Let's start with our actual results. We have the actual amount of sales revenue, variable costs, etc. that we incurred during the period because it's contained within our income statement. So we can just go and copy the numbers from the income statement right into our actual results column, and we're going to arrive at an end number of operating income of 74,800. Let's next fill in our static budget, which is the revenues and costs for the level of production that we intended to do. Well, we have that information too. In our flexible budget, one of our levels of production was 10,500 units. That must be the level of production that we used for our static or master budget. So we can fill in the information from our flexible budget for that level of production, found right at the top. That's $241,500 in sales revenue, on down through until we arrive at an operating income of $54,000. Now we need to fill in our flexible budget column. What things should have cost given the fact that we actually made and sold 12,500 units. And the first thing we're going to need to make that happen is our budgeted units amount. We intended during the period to sell each unit for $23 and to spend $13 per unit manufacturing that in variable costs. So our materials, our labor, our variable overhead, etc. Well, to fill in your flex budget column, all you're going to do is take your actual amount of units at the top, that 12,500, and multiply it by your budgeted unit amount. If we sold 12,500 units and we sold them at a price of $23 a piece, that means we should have had sales revenue of $287,500. Same concept for variable cost. Just take the actual level of production we had, 12,500 units, and multiply it by your budgeted unit amount. For variable cost, it's $13, which means those 12,500 units should have cost us $162,500. We know that contribution margin is just revenue minus variable costs, so that would have been $125,000. Next up, we have fixed costs. And this is kind of a strange thing, but it makes sense when you wrap your mind around it. What the flex budget does is it takes your costs for the period and states what they should have been by adjusting to the volume that you actually produce. Well, fixed costs shouldn't vary with production levels. It doesn't matter if we made 1 unit, 100 units, 100,000 units, or 100 million units. When we have a level of fixed costs, those fixed costs should stay the same regardless of the level of production that we have. So for the fixed costs of our flex budget, we can just carry over the fixed costs that we had on our static budget, because again, they should have not changed even though our production increased. And because operating income is contribution margin minus fixed costs, we're going to have operating income on our flex budget of $74,000. Our operating income should have been $74,000, seeing that we made and sold 12,500 units. So now we get to go and we get to fill in the gaps. Let's start with the sales volume section. Our static budget says that we should have had sales revenue of $241,500 based upon selling 10,500 units, but we actually sold 12,500 units, which means our flex budget says our revenue should have been $287,500. That is a difference of $46,000. I just subtracted the two numbers from one another. And then you put an F next to it, and the F means favorable. Why is this variance here favorable? Because revenues, if you read right to left, are going up, and more revenues are always good for a company, so it's going to be favorable. Let's just move on down the line. For variable costs, static budget said $136,500, but the flex budget says we should have had $162,500. That is a difference of $26,000, and it is unfavorable. Why? Because it's more cost, and paying more cost is bad for the company. The difference between our static budget and flex budget contribution margin was $20,000, and it's going to be favorable because more contribution margin is good for the company. The difference between fixed costs on our static budget and flexible budget is zero, neither favorable nor unfavorable. And our operating income has a $20,000 difference between our static budget and our flex budget. Again, reading right to left, it's going up. More income is always good for the company, so that's favorable. Let's do the same thing for the flex budget variance column. And in the flex budget variance column, sales revenue is going up by $7,000 from our flex budget to our actual results. And again, more revenue, always favorable. Variable costs are increasing by $5,200. An increase in costs is unfavorable. Our contribution margin is $1,800 higher in our actual results than what our flex budget says it should have been given our level of production. And since it's a higher contribution margin, that's good, so it's favorable. Fixed costs were $1,000 more than we expected them to be. That's unfavorable. And overall, our flex budget says we should have had operating income of $74,000 given our level of production, but we had actual operating income of $74,800. So that is a difference of $800, and since it's more income from our flex budget to our actual results, that's favorable. And with that information, we can compute our static budget variance, and that's just the difference between our operating income on our static budget and our actual operating income from our actual results, and that difference is $20,800. So what does this all mean? Well, the difference found in the sales volume variance is how much of that increase between your budgeted income and your actual income can be attributed purely to the fact that you sold more units, right? If you sell more units, you're going to have more income. So for ABC Company, they are saying that $20,000 of that $20,800 difference can be attributed to the fact that they made and sold 2,000 more units during the period. The difference in the flex budget variance column is everything else. So $800 of that $20,800 difference between our static budget income and our actual income can be attributed to things besides that 2,000 extra units of sales that we did. What could this be? Maybe we got a higher selling price per unit. Maybe we got our materials cheaper than we thought we were going to. Maybe it took our laborers less hours. There could be a ton of different things that went in there, but this is just a big grouping of all of the different reasons that your income could have been higher or lower than what it should have been in your flex budget. And it's anything that's going to increase income that's not attributed to just an increase in sales volume. So that flex budget variance could be a lot of things. Well, how do you figure out what it is? You can break it down farther, and to do so you're going to have to do a variance analysis. You're going to have to use varying formulas to determine, okay, how much of that difference can be attributed to, say, the cost of our materials or the cost of our labor, which is where we're going to start. So let's take this example, that during September of 20XX, ABC Company produced and sold 107,000 units. The company had the following cost standards and actual costs for the four components of production. Those four components are direct materials, direct labor, variable manufacturing overhead, and fixed manufacturing overhead. So the information that we have here is what we actually spent. That comes in the actual cost information. We actually used 209,000 parts for direct materials. We paid 22 cents per part. Therefore, our total cost was 45,980, etc. Standard cost is your budgeted input quantity per unit. So what we said is that each unit that we made should have taken 2 parts, and each part should have cost 17 cents. Each unit should have taken 0.02 hours to produce, and we should have paid our laborers $8 per hour. So the standard cost information is what you budgeted for. The actual cost information is what it actually was. And using that, we can fill in these formulas to figure out what portion of these variants that we have can be attributed to these different components. So let's start with the direct materials cost variance. It's found by taking the actual cost of materials and subtracting out the standard cost of materials, and then multiplying it by the actual quantity of materials used. So our actual cost per materials, and we're going to break this down to the unit level, should have been 22 cents per part, taken right from our actual cost information. Our standard cost, we said what we budgeted for was to spend 17 cents per part, found in our standard cost information, which means we paid 5 cents more per part than we planned on. Well, if we multiply that by the actual amount of parts that we used, which found in our actual cost information was 209,000, that's going to be a difference of 10,450. So that is the portion of cost variance from our budget to our actual results that we can attribute to the fact that we paid a different amount for materials than we budgeted for in the first place. And I put a U next to it. It's unfavorable. Why? Because we paid 22 cents per part when we only budgeted to pay 17 cents per part. So since we're paying more for our direct materials, that has got to be unfavorable for our company. Let's do the same concept with direct labor cost variance. It's going to be the same setup, the same formula, but now we're going to go with our direct labor costs. So our actual cost of labor found in our actual information is $8.10 per hour, what we paid our employees. Well, we budgeted in our standard cost information to only pay them $8. So we paid 10 cents more per hour to our employees than we planned on. And if we multiply that by the actual number of hours our employees worked, which was 1,640, found in our actual cost information, we're going to come up with a direct labor cost variance of $164. And again, our actual cost of labor was more than we budgeted for. Since our costs were higher, that's unfavorable to the company, so it's $164 unfavorable. So we can attribute $164 in the difference between our budgeted operating income and our actual operating income to the fact that we paid more for direct labor than we planned on. Moving on, we have our efficiency variances, and this is how well we did at controlling not the cost but the amount of input that we use. So for materials, did we use the number of parts that we were planning on? Or did we waste parts? For labor hours, did it take our employees the budgeted amount of hours to complete production, or did they spend more time to make these units than we had planned on? And the formula for this is actual quantity minus standard quantity times standard cost. So for direct materials efficiency variance, the actual quantity of materials that we use was that 209,000 parts found in our actual information. Well, how much did we budget for when we made out our budget? Well, we budgeted that each unit was going to take 2 parts. And since we produced and sold 107,000 of them, 107,000 times 2 means we should have used 214,000 parts. So we actually used 5,000 less parts during the period than we'd planned on. Well, if we multiply this by the budgeted cost of direct materials that we had, which was 17 cents, we're going to come up with $850. And that is favorable. Why? Because we used less material. Our actual quantity was 209,000 than we budgeted for at 214,000. So we can explain $850 of difference in our income to the fact that we didn't have to use as much material as we thought we were going to have to at the beginning of the period. Let's do the same thing with our direct labor efficiency variance. Actual quantity of labor, actual hours worked, was 1,640. The standard quantity of labor, how long it should have taken, well, let's do the same concept we had before. Each unit should have taken 0.02 hours to produce, and since we made 107,000 units, let's multiply that 107,000 times 0.02, and we're going to come up with 2,140. So it actually took our laborers 1,640 hours to make these units. We budgeted that it was going to take them 2,140 hours. That's a huge difference. In fact, if we multiply it by our standard cost for labor, how much we intended to pay our employees at the beginning of the period, which was $8 an hour, we're going to come up with a whopping $4,000. So $4,000 of the difference in our income can be attributed to the fact that we didn't need to pay for nearly as many hours as we thought we were going at the beginning of the period. And it's favorable. Why? Because as the company, if your employees work less hours, you pay less labor costs, and less cost is always good to the business. Move on to our variable overhead. We have two different formulas here, the cost variance and the efficiency variance. Starting with the cost variance, what was the actual cost of our variable overhead? Well, over here we have a bunch of information that's going to help us get there. It tells us that our overhead is based upon, we have fixed here, a certain amount of fixed costs, and we have a certain amount of units produced. We budget to produce 97,000 units. But the big one here is that we budgeted for 1,940 direct labor hours at the beginning, and we were going to allocate our overhead over each hour because direct labor hours is our cost driver. So for actual cost, what we need to do is take that $14,000 in variable manufacturing overhead costs that we have and divide it by the actual quantity of our cost driver. So if we take $14,000 in actual variable manufacturing overhead, divide it by the actual amount of our cost driver, direct labor hours that we had, we're going to come up with this hideously ugly number, and it happens sometimes. So we get $8.53 and a bunch of more decimal places after that. That is the actual cost per unit of our cost driver that we paid in variable overhead. Well, in our standards, it said we expected to pay $9 per hour for variable overhead. That's what we're going to allocate our overhead at. So let's multiply that by the actual quantity, and this, because it's overhead, is the quantity of the cost driver. What was our actual quantity? It was at 1,640 hours that our laborers worked. So if we multiply that out, we come up with $760, and it is favorable. Why? Because the actual cost of variable overhead was lower than we budgeted for when we made our cost standard. So we have a $760 favorable variable overhead cost variance. For efficiency, let's do the same concept. The actual quantity of our cost driver that ABC Company had during the period was that 1,640 hours of direct labor. Well, what's our standard quantity? Well, if we go up, direct labor, it should have taken 0.02 hours per unit. We made 107,000 units, which means we should have had 2,140 hours of labor if it did indeed take our employees that long to make each unit. We've seen this number already. This is our standard quantity of direct labor. Well, it's going to be the same thing for the standard quantity of our cost driver because direct labor is our cost driver. Let's multiply this by the standard cost that we had, and our standard cost, again, for variable manufacturing overhead was $9 per hour, and we get a $4,500 favorable cost variance. So what does this mean? Well, we were allocating out costs based upon how many labor hours that we had, and if they didn't work as many hours, we won't have allocated as much cost. So Our $4,500 difference in here can be explained by the fact that we were very efficient with our cost driver, and it caused less overhead to be allocated to these particular units. Lastly, we got our fixed overhead. And the first formula for fixed overhead, the cost variance, is the easiest thing you're going to come across. Our actual fixed overhead from our actual cost information was $31,000. And then in our standard cost at the bottom, it says we had a static budget amount of fixed manufacturing overhead of $32,980, which means our actual fixed overhead was $1,980 less than we budgeted for, and it's therefore favorable. On to our fixed overhead volume variance. This is going to be our budgeted fixed overhead minus our allocated fixed overhead. Well, our budgeted fixed overhead we already have. It was at $32,980. How do we figure out our allocated fixed overhead? We're going to figure that out by using this formula. We're going to take our actual production in units and multiply it by the quantity of our cost driver per unit, and then we are going to multiply that product by the allocation rate. So our actual quantity of the cost driver per unit was 0.02 hours. If we multiply that by our actual production in units of 107,000, and then multiply that product by our standard cost for fixed manufacturing overhead, the product of all three of those numbers together is going to come out to be $36,380, which means we budgeted to have $32,980 in overhead, but we actually allocated $36,380 of fixed overhead to these particular units, which means our fixed overhead volume variance has a difference of $3,400, and it is favorable. And of all the things in accounting, this is one of the things that took me the longest to wrap my head around, until just one day something clicked to me, and it is this. The variance for your fixed overhead volume depends upon what your actual production was versus what your budgeted production was. Sure, we allocated more fixed overhead than we thought we were going to, but why? Because we made more units than we thought we were going to. And when we make and sell more units, it's got to be good for our company. So even though we allocated more overhead to this, that's good, because that means that we made more units during the period. So since our actual production of 107,000 units was greater than our budgeted production of 97,000 units found at the bottom of our standard cost information, our fixed overhead volume variance has to be favorable. Good luck on your quiz, everybody.